9 a.m. Let's get started. Thank you so much for joining this monthly portfolio review and trade review, as well as Q&A session. I'm really excited about today because I'm going to go deep into an advanced trade in a few slides here. And that's one that produced over 100% return on investment in less than 6 months. So that annualized, if we can realize that with trades like this would be over 200%. Doesn't always work out like that, of course, but the potential is really amazing. So I want to share with the community and everyone who's watching what we did to get there and how you may be able to achieve similar results. If you want to join this live at any time, go to saltmoneyoptions.com. You can join our community there and then hop on the Zoom. That's also where you'll be able to ask questions after this initial session here. Okay, let's jump in and go through just a few disclaimers. This content is for educational, informational purposes only. There are no guarantees. I recommend you always do your own research. This is not financial advice, nor legal, professional, or any kind of other advice. Either ask professionals or do your own research and know that all investment involves risk. So the portfolio that we are tracking at saltmoneyoptions.com in our community is a Roth IRA portfolio that started at around $10,000 last year and is up significantly since then. But if we just look at the last month here, we can see the value went mostly sideways, but we do have a 5.2% increase over the month. And we also see at the bottom, we have $1,190 in buying power. So we plan to deploy that sometime this week, probably to sell some cash secured puts. The amazing thing about being involved with stock options is that you can generate cash flow by either selling calls or selling puts, and you basically get paid to enter a trade. And then either you buy the shares at a discount or you generate cash flow for shares you already own through covered calls. So you're basically improving the returns on your entire portfolio. And that's how we and the members in our community are able to double our stock portfolio every 1 to 2 years. That's whether it's 1 or 2, depends mostly on how deep you want to go into the skill level, on what kind of option trades you want to involve to get the results. And also has a little bit to do with the fact on how much time you're willing to spend. Just spending 30 minutes a week is what I did last year on average. And I was able to generate 6 figures in return on a portfolio that started with around $220,000, $230,000. So that's very close to 40% ROI, or actually it went above 40%. It got around 50% ROI last year. And that's possible just with a very small amount of time investment. But if people want to go a little deeper, they can actually get higher returns, spend a bit more time, maybe double or triple that time on a weekly basis. And you can get close to doubling your portfolio with the strategies that we use. Okay, let's look at the first trades that we had in the last month. So on the left side here, we see an American Airlines put that we sold on October 20. Actually, no, we sold it on September 25th. And at the top, we see the expiration, October 24th. That's when the option expired. And one of two things happens if you sell a put. If the price of American Airlines, ticker symbol is AAL, if that is above $11, that's our strike price, then we just keep the premium that we earned for selling this put. And the premium, you can see that at the bottom left, that was close to $48. And the money that we put at risk for this trade was $11 times 100. So that's $1,100, which is a pretty good return on investment. It gets close to about 4% ROI on the monthly basis. That was in our target range. And American Airlines current price, I think it's a little over $13. So that put expired worthless last Friday, and we get to keep the premium. And the other trade we shared with the community on the right side, we have MSTU. That is a leveraged ETF for MicroStrategy, which buys Bitcoin with a little bit of leverage as well. So this was a more risky trade. I do not recommend this for beginners. But you can see in exchange for the risks that we took here, we were also able to collect a larger amount of premium. So with the strike price of $4, we sold 3 puts at this price. So we put $1,200 at risk and got a return on $155 or a credit for over that amount. So that's over 10% ROI for the month. And that being that was a little bit more of a risky trade, we also got assigned on this put option. I think on Friday, the price of MSTU was around $3.50. Today, it's a little bit higher. I think it's closer to $4. So we'll be looking to sell covered calls on the 300 shares that we got assigned for this trade. Yeah, so sometimes if you're a little bit more experienced, you might be willing to do more advanced trades like this, but I do not recommend this for beginners. And also a reminder, of course, no financial advice. So this is kind of just showing the post that we had in the community introducing the 2 trades. And another one that we mentioned as part of this, we were also considering to sell some puts on Rocket, which is a mortgage company that also recently acquired Redfin. So they are expanding in the real estate field. And since that field is kind of due for recovery, it might take another year or 2, maybe 3 years, but eventually I believe that field will recover. So that should send this stock price higher as long as the company continues to execute well. I think they're pretty well positioned to do so. So we were also looking at selling some puts on that company. But we recommended to watch for a strike price of $19 or lower. Don't sell it higher than that because the stock has been a little bit volatile, so we don't want to get caught on the wrong side too early. Okay, next up, we are ready for our advanced trade review. So this is not for beginners, but I want to kind of share with you what's possible once you understand options a little deeper and see the kind of returns that you can achieve, and also what mechanisms people use to reduce the risk on these kinds of trades. So there's a lot of information on the screen, and I want you to look on the left side first. So that's basically a history from Robinhood on what happened with the stock that we sold options on. The stock that we invested in here was United Healthcare. And what happened, let's look at the bottom on May 16th. There was some negative news about the company. I think the CEO of the company was being investigated by a federal agency for something that they didn't do properly. And that caused the price of the stock to go down significantly. And that's, of course, a higher risk scenario. But after that had corrected a good bit and it looked like it was starting to form a little bit of a bottom, I decided to invest in this stock since I did not have any exposure to the health technology sector and I wanted to expand into it. So I just started a smallish position for our larger portfolio. This trade was done in the larger portfolio, not in the Roth IRA portfolio. And that when I opened the trade, it cost $1,525 to kind of get exposure to roughly 100 shares of United Healthcare. And that is, if you look at the stock price, I think at the time it was around $300. $300 multiplied by 100 shares, that would require $30,000 in cash to get basically buy the shares or in portfolio buying power. And let's look at how were we able to get exposure to close to 100 shares for just $1,500. That seems kind of too good to be true, right? And if you're thinking that way, that's a good way to think about it, because that makes you curious and you want to see how did we actually do this. So that's where we get to look on the right side, because that tells us in detail on what kind of position we were opening here on May 16th. So the top position, we see a sell of a United Healthcare call at $350 strike price expiring in August. So that was about May to August. It's about 3 months later, if my math is right. And then right below that, we're actually buying a a call that expires next year in June. So those two together are called a vertical call spread. Vertical because the price is not the same. If the price was the same, it would be a calendar call spread. But since the price is slightly different, the call we sold is slightly below the call we bought, it would be considered a vertical spread. But since we are buying a call, we don't need to own 100 shares to sell a call on this position. And that's something that requires level 3 options permission. It's not the lowest level, but once you have that level enabled in your account, then you can sell basically spreads like this. And if we look at the prices for the transaction here, so buying this call at $360 price cost $3,109. And I'm just multiplying the price on the right here with 100 because that's the price per share that we see there. And then we sold the call against it, which was $1,187. And the sold call, of course, reduces the purchase price that we had to pay to buy this more long-term call, which is also called a LEAP, by the way, long-term equity appreciation position. So that reduced our purchase price to a little below $2,000, but we're not yet at the $1,525 that you see at the top, right? In addition to doing this, we also sold a put credit spread where the sold put was at $250, so it was a little higher, and we got a credit of $2,345 for it. And then we bought a put at $240, slightly below it, kind of to reduce the risk of the position at $1,948. So the difference of these two, whoops, jumped back for some reason. The difference of these two puts that we sold and bought, that's basically what we can also count against the purchase price of our call position. So $23.45 minus $19.48, that's around $400 in credit that we're getting from this put. And that reduced our purchase price that was a little below $2,000 after this covered call was applied here to $1,525. So that's basically how we were able to enter the position. But let's also talk about the risk here, right? Because a trade like this is not without risk. And I really want you to understand the risk well, because that's where investment becomes less risky once we understand the risk and we have different ways to manage it. So the risk on the put side is $10 times 100. So we have $1,000 of risk that United Healthcare might drop below $240, and then the entire difference of $240 to $250 strike price, we would have to kind of pay in order to close the position if the price went that low around August 15th. But of course, once you are more experienced with selling options, you also know if the price really went there and it went there, let's say a few weeks before August 15th, waiting it out is not your only option as an option investor or trader or seller, right? You can also roll the put into the future if you think maybe the price will recover in the future. Oftentimes, you may even be able to roll the strikes down to reduce the risk further. So there are a few different options to manage a position. But initially, to open it, we have $1,000 of risk on the put side, in addition to the $1,525 we purchased or we paid to open the position. And then we also have $1,000 of risk on the call side because the sold call was $10 below the bought call. So $2,000 of capital that was kind of secured by this position, plus $15.25, that's $13.25. And let's look at the return for this position. I'm gonna jump one step ahead real quick. So the return that we see calculated by Robinhood here is $1,583. And that comes back at like 68% on the investment that we had on the initial call. But that's actually not the full truth, and I'll explain to you why. So the real return that we had in this position is actually closer to $3,885. And that's where we are basically above 100% ROI for this position. And in order to understand why the return is higher and why Robinhood is not showing us the full truth here, we have to go back one step again and look at what happened in the meantime. So we opened this position in May 16th, and then on the 19th of May, just 3 days later, I was actually able to roll the covered call higher from 350 to 360 for a $60 credit. And that removed the $1,000 risk that we had on the call side and paid us a little credit as well. And the reason I was able to do that is because the price of the stock had slightly recovered. So just 3 days later, and the capital, $1,000 were freed up again. And then on July 1st, which is a month and a half later, we closed the put credit spread that had another $1,000 secured for the trade, right? And for that one, we didn't get a credit. We paid $55 to close it early, but that was a great investment from my perspective, because if we hadn't done this, we would have had to wait another month and a half, and the $1,000 would not have earned any return during the time. So it was, a useful option to kind of close it at that point, because United Healthcare stock had recovered some, and we were in a better position there. And then on August 1st, another month later, we also closed the covered call that was rolled up to $360. Closed it early for another premium that we paid, in this case, $45. So now we are basically a little bit above our $15.25 entry price that we had, because first we earned $60, then we paid $55, and we paid another $45. So we're like $40 down. So we paid $15.65 at this point for the position. But then a nice thing happened since we closed this call on September 19. In October, the price was higher again. So we could sell a fresh call on it for $1,000 in premium. And this is where it gets interesting, right? Now you count $1,000 against our purchase price to enter the position. So now we almost have a free trade, because we only have $565 left in hold that we kind of purchased at that point to hold the position. And we have until June for the price to kind of go up, hopefully a little bit. Or if it doesn't go up, then we can sell additional calls against the long-term call to generate more premium. And that's kind of what we did on October 3rd. We rolled the call a little bit higher. I do not remember the price that was rolled to. Maybe we rolled it to $375, $380, something like that. Collected another $80 in premium. And then on October 23rd, which was just last week, we rolled it higher again for another $800 in premium. And that's where we got in the money into the entire position. So now we are basically holding this position. Let's go to the next page. After that roll last week, we're just holding the long-term call with a sold call against it for a value of $3,885. And we have all our costs paid off. So that's basically where this gets interesting from an investment perspective. You can open positions in stocks if you plan this well, if you have a good strategy, and if you find a good entry price with less capital requirement, and by the premium that you apply against your cost, you can reduce the cost of the position and make it profitable much sooner than a traditional investment will. So you can basically have more of these positions at the same time. And the risk is basically close to zero, right? Or actually it's a positive risk in this case, because the call we sold is $10 away from the call we bought. So we have $1,000 buffer guaranteed there. If the stock price went above $370 by October 31st, and somebody wanted to exercise the option on the call, then we could basically close this call to service that exercise, and we would still get premium for closing the call. So it's basically a no risk option at this point, and we can just continue to either roll covered calls, or if a call expires worthless, we can sell new calls to generate cash flow until we come to June next year, where the call will either expire worthless, probably not worthless, or we can sell it for hopefully a juicy premium that we get from selling it sometime close to June 18th. So that's kind of how more advanced trades like this work. I hope this wasn't too overwhelming, but we will also explain these strategies in detail in our more advanced community that we have on School. You can get there by going to stockoptionpros.com. We go through strategies on how to find stocks for trades like this, and then also how to execute and manage these positions over time so we can get larger returns. Okay, that's pretty good for the advanced trade. If you have any questions, feel free to let me know in the comments, or send us a message in the community. And for those who have joined live on Zoom, we can also go over questions in the Zoom call in a few moments here. This is just a view on what the community looks like on the inside. In School, we have an option selling bootcamp where you can learn all the fundamentals on how to grow your portfolio by selling stock options and get returns that most stock market investors just dream of. It's kind of surprising to me that people don't talk about this more, how kind of easy this is to learn and how beneficial the results are. So that's why we started this community, to make it more known. And we really have a low barrier of entry price here. Initially, we launched the community at $7 a month. It's now slightly increased at $9 a month, but it's still such a low price for the value that you receive. You've seen in the earlier slide that just a simple put that we sell on American Airlines generated, I think, $45 in premium. So just one sold put, if you have $1,100, would have paid for the membership for several months, right? If my math is right. Yeah, almost 6 months if you got the $7 price, or like 4 to 5 months for the current price. So that's really a great investment. And the reason we don't just have this community available for free is we want people in there that are actually committed to learning the skill and also applying what they learn. This information is already available for free on YouTube. You just need to search deeply enough, know how to find it, ignore all the things that are leading you into the wrong direction, that are leading to investment decisions that are too risky. But if you're committed to kind of learning in a very time-efficient manner, just the information that you need to get consistent results, then this community is the right step forward. Okay, let's one more view. That's just the different modules we have inside of the option selling bootcamp. And since these slides were created, we actually also added a few more content pieces, and we'll add more over time. So this is going to be really fundamental, very easy to implement, and people will get a skill set that they will be able to use for life and also share with other people in their environment to kind of help them enjoy more financial freedom. Because that's really the mission that we have at Salt Money. We want to help people enter into financial freedom so that they can achieve the things that they have in their heart, the dreams and purpose in life. There's so many things that can be done on this planet, and with technology advancing as it is, I think it's just an enabler to even do more good and to help more people. So I'm really excited for the season that's ahead. I hope you are as well. And yeah, if you want to join us, if you're not ready yet, feel free to hang around, continue to check out our content on YouTube and Instagram and X and other platforms, and read our email newsletters, so you can kind of learn step by step on how to grow in your financial understanding and impact. We will transition to the Q&A session now, and we wish all of our live streamers a great week. Thank you so much for joining.